Every quantitative strategy boils down to three distinct profit engines. CTA rides trends, cross-sectional picks winners from a basket, and statistical arbitrage bets on prices snapping back. Understanding these three is your coordinate system for the quant world. We'll dissect each, their math, and how top funds combine them. CTA, or Commodity Trading Advisor, now broadly means managed futures. Its core is time series momentum, predicting an asset's direction from its own past. When a market trends up, you go long. When it trends down, you go short. In choppy markets, you get whipsawed. The essence is buying volatility and persistence. Classic signals include moving average crossovers, breakouts, and Donchian channels. AQR's famous approach: go long if the past 12 months return is positive. Why does trend following work? It relies on positive autocorrelation in returns. If today's return correlates with yesterday's, then a simple rule, go long after a gain, short after a loss, has positive expected value. The formula says, if the correlation between returns at time t and t minus k is greater than 0, the trend strategy earns. This is the statistical foundation of momentum. CTA's superpower is crisis alpha. It often profits during market crashes like 2008 and 2020, because trends become violent. Its low correlation to equities makes it a diversifier. But the pain is real. In range-bound markets, it suffers repeated stop-outs, sometimes losing for 12 straight months. And capacity is limited. The more money chases trends, the weaker the signals become. Cross-sectional strategies compare assets at the same moment. You sort a basket of stocks or futures by a factor, like value, momentum, or quality, then by the top decile and short the bottom. This cancels market beta, leaving pure relative return. Classic factors include low price to earnings, high past returns, small size, high return on equity, and low turnover. The soul is factor efficacy. Cross-sectional returns are often modeled with a factor regression. Each stock's return is explained by its exposure to common factors plus an idiosyncratic part. The alpha is the intercept, the return not explained by the factors. If you build a portfolio with zero beta to the market, you harvest that alpha. The model, return equals factor loadings times factor returns, plus stock-specific noise. The biggest pain is factor decay. Value worked for decades but underperformed from 2007 to 2020. Momentum weakened after 2009. Why? Crowding. When everyone buys low price to book, it stops being cheap. New factors have shorter half-lives. A factor discovered in the 90s might last 10 years, today, maybe 2. Also, shorting is hard in some markets, and small caps lack liquidity. Stat Arb assumes that two related assets maintain a stable long-term relationship. When the spread deviates, you bet on reversion. Classic pairs trading. Find co-integrated pairs like Coca-Cola and Pepsi, or WTI and Brent. When the z-score exceeds 2, you short the spread. When it's below -2, you go long. The profit comes from the gap closing. Holding periods are short, days to weeks. The mathematical backbone is cointegration and the Ornstein-Uhlenbeck process. If two prices are cointegrated, their spread is stationary, it reverts to a mean. The OU model describes that the change in spread equals a speed of reversion times the deviation from the mean, plus noise. When the spread is far from the mean, the pullback is stronger. That's the engine of Stat Arb. The dark side is tail risk. The assumption that mean will revert can break. In 2008, Lehman's collapse snapped all pair relationships, and Stat Arb funds blew up. The spread can diverge further instead of reverting, causing unlimited losses. Cointegration is fragile. Mergers, policy changes, or regime shifts kill it. Capacity is the smallest, often pushing institutions into high-frequency trading. Let's compare the three across key dimensions. CTA is time series, directional, and has positive skew, occasional big wins. Cross-sectional is market neutral, with symmetric returns and factor risk. Stat Arb is also neutral but has negative skew, occasional big losses. Holding periods, CTA weeks to months, cross-sectional weeks to quarters, Stat Arb days to weeks. Capacity, cross-sectional largest, stat arb smallest. So how do you choose? If you want crisis protection and low correlation, CTA is a must. If you believe factors persist and need capacity, go cross-sectional. If you want high frequency and high win rate, stat arb, but manage the tail. Top funds like Renaissance, 2 Sigma, and Millennium run all three. CTA provides crisis alpha, cross-sectional gives steady excess, stat arb adds high-frequency returns. Together, they can push sharp ratios above 2. We've mapped the 3 pillars: CTA rides trends, cross-sectional exploits relative value, and stat arb bets on mean reversion. Each has a distinct statistical foundation and risk profile. Understanding them gives you a coordinate system for the quant universe. We'll be exploring each strategy in depth in future episodes. Thanks for watching. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.